Okay, we will go ahead and begin our webinar today. And I want to thank Jeff Bowman for volunteering his time and really having some very valuable information that I haven't seen that really clarifies things a lot for me. Jeff Bowman speaks with more than 30 years of practical experience in the banking industry and currently serves as the president and CEO of Bay Bank in Green Bay, Wisconsin. The bank is owned by the Oneida Nation, and Jeff is active in several organizations that facilitate economic and small business development. So I welcome you, Jeff, to today's webinar, and we're going to kind of switch things up here just a little bit. And we're going to start off with Jeff. And Jeff, if you would just like to maybe just say a few words about how this all came about. And I really liked your conversation that you had with the Treasury in regards to them not seeing this before. And what you presented to me it's very practical and makes a lot of sense. And I think it's going to really clarify things for people today. Yeah. So I'm going to turn it over to you, Jeff.
Yeah, sounds good. Thanks, Pete. Good afternoon, everybody. Poso, Kulamose, Saguli, from Green Bay, Oneida, with part of the Oneida Reservation overlaps onto the city of Green Bay. So I am talking to you from what we call Titletown, USA. I prepared a presentation. I'll screen share that with you in a minute. And what I'm going to share with you is like the granular detail of how to do some loan projections in regards to the loan participation program. So when this first came out, our shareholder, the Oneida Nation, came to us and said, Jeff, can you work on this program? And then Menominee tribe in Wisconsin, we have a bank branch in their community. They also came to me and said, hey, can you help us work on it? So between the two teams, we've just accumulated a lot of information. We're at the point where we have our narrative written. We're both going with a loan participation program. And if you study the other credit support programs, you can do venture capital, you can do collateral support, you can do loan guarantee, you can do loan participation programs. I found that loan participation program was the easiest program for me to wrap my head around. So day to day, I am a commercial loan officer by training. I've been doing it over 30 years. So I've helped start a Native CDFI in Wisconsin. I'm on the board of a couple Native CDFIs. I'm the board chairman for OWISTA. And my mind every day is just thinking loans, loans, loans. So I just have that working knowledge of how projects put together. And then I put that into a spreadsheet so we could read it and look at it and wrap our mind around it. And so I cut and pasted some of those items into this presentation. So after this, I'll email it to Pete, and then his team can email it out to you guys, and you can take a look at it. My contact information is on there, so if you want to talk to me, you'll know how to get a hold of me, okay? So I'm going to screen share and bring this up. Okay, can everybody see this?
Yep.
All right, so we're going to talk about the loan participation program. Okay, I'm a banker. I'm not a lawyer. So I wrote this disclaimer the best I could. Okay, I'm not an expert in SSBCI. I am an expert in banking. Okay, so I'm trying to go between these two worlds of knowing the banking side of things and learning SSBCI literally on the fly. Okay, so these are not the views of Bay Bank. This is the information I've collected over the last couple of months. And again, it's specific to the loan participation program. So here's some items that I'm going to cover today. What does the mix of money look like? The Treasury application uses the terms private funds and public funds. The private funds are going to be owner's equity, like a down payment, and a bank loan, or it could be a loan from a CDFI. Public funds are these dollars being allocated to you, okay? So what does leverage look like? And then should the leverage ratios change by transaction? And we'll examine that. And then what does it look like when you do a bunch of transactions? What does it do to your leverage ratio? What are the participation rates? Your application in a spreadsheet is going to ask you to speak to your average participation percentage. I'll show you how to figure that out. And so how do we take all this and build our own projections And then I'm going to transfer these items into the leverage table provided by the Treasury. I did all my work in a single spreadsheet before I even attempted to insert it into the Treasury table. So last week on a call, we had folks from the Treasury. Jim Collin is one of them. And then he's got a lot of teammates that are absolutely awesome. And so I've had, I'm not kidding, a dozen conversations with them over the last month and a half on every item that comes up. So the numbers that I'm going to show you, the methodology, I've shared that with them and they've confirmed that you're thinking the right thoughts. You're on the right track, okay? All right, so, all right, this is what it looks like for the one deal. We have a $100,000 project. Customer comes to you and says, I want to buy a dump truck, okay? So what is one-to-one leverage? That could be $50,000 from the bank, and it could be $50,000 of your SSBCI money. You pull them together, you have a $100,000 project funded. So the bank, the private lender, could make a $100,000 loan, and the SSBCI could buy a $50,000 participation interest in it, or it could be two separate loans. It doesn't matter for the purpose of participation percentage and leverage. So this is super simplistic. You'll read over and over in an application that the minimum leverage is 1-to-1. So by definition, that's 50% of bank money or private money, 50% of SSBCI. That's the minimum, 1-to-1. Over a 10-year time frame, you have to aggregate or have a cumulative leverage ratio of 10-to-1. And if you read the operative words, a reasonable expectation that you'll reach 10-to-1, okay? So that to me was a very daunting goal, made me nervous because I'm like, how is this really gonna work? So if I made loans at 50% participation, how many loans would I have to make to get 10-to-1? I'd literally have to have the person borrow the money, pay it back, and I'd have to lend it out 9 more times, right? 10 times. That doesn't work in the loan business. For me at the bank, and from the Native CDFI standpoint, we make 3-year loans, we make 5-year loans, we make 10-year loans, okay, depending on the, whatever the structure is. So, so what I'm trying to show you on this slide, really simple. What is leverage? What is participation? All right. Let's say your loan fund is up and running and you got a bunch of projects that you've funded. This is a year or 2 year down the line. One of the things you got to be able to track is your aggregate or your cumulative leverage ratio and your participation rate. So right here at the top, this $100,000 project, that's the one I just showed you on the prior slide. We used 50% participation, 50 grand from the bank. I'm going to use bank and CDFI synonymously, okay? 50 grand from the public money. Here's a $500,000 project. This could be like one of my logging customers on the Menominee Reservation. That guy is going to buy a brand new processor. That's a $500,000. We could structure that with a $500,000 from the $250,000 loan from the bank and a $250,000 loan from the loan fund. Again, we got 1-to-1 leverage and 51% or 50% participation. Now we got a $300,000 project. Someone in the construction business wants to buy 2 dump trucks. Well, let's get 200 grand from the bank and $100,000 from the loan fund. Well, that's 2-to-1 leverage. You take your private funds, divide it by your public funds, and then that is a 33% participation because the public money of 100,000 is 33% of the total funds. Now I got a $500,000 project. We're going to get 400 grand from the bank and 100 grand from the loan fund. I got a $250,000 project. We're going to get 200 grand from the bank, 50 grand from the fund. And what I've done here is I've created transactions that have 4-to-1 leverage, and the SSBCI is 20% of the total funding. And then I got a big one, $1 million, $500,000 from the bank, $500,000 from the loan fund, 1-to-1. All right, so picture this being an Excel spreadsheet. We're going to add up these columns. I funded $2.6 million worth of projects. It attracted, it's one of the words you'll find in the application materials. You have to leverage and attract private money. We invested $1.05 million in these projects. It attracted $1.6 million of private investment. My leverage ratio is 1.5. And my average participation is 39.6%. Here's a little cheat note right here, shows you how I got that. So here's the takeaway. Every one of your projects is going to have a different mix of funding. There's no right or wrong answer here. But what you have to be mindful of is you have to reach a 10-to-1 ratio in the 10-year life of your program. So by designing or using different leverage ratios per transaction, you can start driving that number up, okay? All right, so the takeaway here is, how am I going to get the 10-to-1? I already deployed $1 million of my SSBCI money, and I'm only at 1.5. Now, if every one of these loans repaid in 2 years, and you could replicate this activity 4 more times, you might be in the 8-to-1 range, okay? But that's not unreal. That's not realistic. Loans pay back in 3 years, 5 years, 10 years. All right, next slide. This is the exact same data set, but what I changed was the SSBCI amounts. So all of a sudden, I only have one 1-to-1 transaction, and I increased the leverage for a handful of the other ones. By tweaking the amount of the SSBCI money in the pot, now I got my leverage to 3.4-to-1, and my average participation rate is 22%. So I invested $600,000 instead of $1 million in this $2.6 million worth of projects. That's 22%. So the more the leverage, it drives down the participation rate. Okay, so to learn this and really wrap my head around these percentages, I built spreadsheets that had hypothetical transactions. Imagine this same data, but with like 30, 40 rows of just varying amounts. It's really the only way that mathematically you can prove out to yourself is 10-to-1 leverage possible. Now, there is a shortcut. You could do every transaction at 10-to-1. $1 million project got 90,000 from you and 910,000 from their bank. 910 divided by 90,000, 10-to-1. Is that going to work in your market? What happens with the someone needs $20,000 to buy a pickup truck and fill it worth of tools? Are you going to do that transaction 10-to-1? You're going to say, hey, go down to your bank and get a loan for $18,200, and I'll loan you $1,800 because I have to do 10-to-1. 18,000 divided by 1,800. Are you going to make a borrower screw around? And is the bank going to want to screw around with, well, I got to wait for this loan fund to get an $1,800 loan documented for me? So I'm a fan of the process to say, little deals, we're going to give you 50-50 because they're the borrowers that benefit the most. So the analogy that I've been using is we got a pond of fish. We're going to have a bunch of littles. Let's give them a 50% participation rate. And then we're going to have a couple medium-sized fish, and we're going to have a couple big ones. To me, that makes sense on what a tribal business environment looks like in a tribal community. You got a bunch of littles, couple medium guys, maybe one big one. And that big one might be a tribally owned enterprise, okay? So this right here is the pathway to thinking these leverage calculations and participation rates through. All right, so What does it look like when you create your own lending participations? You can use what I just did for you on the prior slide. Only add 10 and 15 and 20 more rows. Change the leverage column, change the participation rate column, and then make sure you have a row on the bottom that totals everything up, and it will calculate your cumulative leverage ratio and your average participation rate. Reason being, that data goes into your treasury table. I'll show you that in a second, okay? All right, this is a method that I'm a fan of. I think it'll work, and we'll see, okay? But little projects up to 50,000, we'll use 50% SSBCI money. If you structured the SSBCI loan as a separate companion loan, you could provide a lower interest rate on that separate loan, which economically benefits the borrower. Then, if you agree to take a second lien position and let the banker guy get a first lien, he or she is going to make a $25,000 loan on a $50,000 truck with a first lien. You're going to take a second lien. So you protect the bank, and it's an incentive to attract their funding. The other thing is, when you structure a companion loan in a second lien position, every subsequent loan that borrower receives until your loan is paid off, you get to count towards your leverage. So you have to have a tracking mechanism post-loan closing to keep aggregating that information. Maybe once a year, you reach out to Joe. Hey, Joe, did you get any more business loans this year? Oh, you did? You didn't lift a finger to do it, but because you've set your program up properly, you get to count it towards your cumulative leverage ratio, okay? So I don't contemplate that here in my math. That's just going to be icing on top of the cake. All right, let's look at a medium-sized fish. Let's say we got a project for 50 to 250. Let's change the ratio 3 to 1. So on a $250,000 project, we'll put in $75,000 of SSBCI funds, and we'll put in $175,000 of bank money. Okay, so you get the point. We're just changing our mix. And then a big deal. So would you want to fund a big deal 50-50? Let's say you only had $1 million calculation. Customer comes up to you and says, I got this great project. You agree it's an awesome project. $1 million to buy a bunch of equipment. I can get 500 grand from the bank. Can I get 500 grand from you? It might be an awesome transaction. But if you had $1 million allocation and you did that loan at 50% participation or 1-to-1, you're almost one and done, right? You just spent half your ammo, gone, one loan. So this structure right here, I call them brackets or ranges. You got to think this through and figure out what would work for you. Maybe it only needs 1 or 2 or 3 or 4, but you have to challenge yourself with increasing leverage as the deal gets bigger so that you spread that money around to multiple borrowers. Plus, you want to be able to accommodate a lot of little fish in your pond, some medium fish and a couple big. All right, so I'm going to share a different screen. See if I can pull this up. So I know this is very small. It's going to be hard to view. This is what loan projections look like. Those ranges I just showed you on my PowerPoint, I have 20 rows set up for small deals, and I have formulas built in here. I have some medium-sized deals, and I have a couple big deals. So here's the takeaway when you do this. You start visualizing how many projects you need to utilize your allocation, okay? So I have $5 million worth of projects I funded right here, 5 million. And the SSBCI funded 883. Well, when you take 883 and you divide it by 5.4, you have a 19% participation. So these are just projections. They're just estimates. But by playing with these different leverage ratios, you're able to aggregate your data and really view whether you're going to be able to leverage these funds. Okay, so now let's talk about leverage. So your money, we spent $883,000 of SSBCI money here. And when you divide it into the private financing of 4.5 million, that's your leverage ratio, 5.2. So I really struggled with the impact and the daunting goal of 10-1. When I look at where our bank is located, our bank is owned by the Oneida Nation. We have 19,000 tribal members. Half of them live in the Oneida Green Bay area. We have plenty of businesses to loan to. Over in a smaller community like Menominee, they have 9,000 tribal members. About half of them, you're going to have a lot more mom and pops and little transactions, and it is super rural there. Okay. In Green Bay, we're connected to, in Oneida, we're connected to Green Bay. The community is, the MSA is probably 300,000 people. Okay, so we have a lot of targets. Okay, so if I had $1 million allocation, I just figured out how to deploy 883 of it in 19 transactions. I have like 1, 2, 3, 4, 5, 6, 7, 8, and I got 10 little ones. I got 7 mediums, 2 big ones. Okay. That's a lot of work. And that was just $1 million. And that only gave me 5.2 leverage. So that's why I mean this 10-1 leverage ratio is a daunting task. Okay. So now what will happen in reality is when you get loans repaid, you're going to be able to lend them out again in the 10-year life of your program. Plus, you'll get to count subsequent financing that your borrowers received from after your investment. So there is a way to get that up. Okay. So here's just another side note. You need to know, let's see if I can increase the view on this. You need to know where your loans come out in their terms. In my assumptions, all the little loans, I haven't paid back in 5 years. The medium-sized loans, 7 years. The 10-year loans, or the big loans, 10 years. Well, these are just the resulting percentages. You have to use these numbers in your treasury table. Okay, so I'm going to show you that next. So let's go back to the presentation. All right, the treasury table. And I'm almost done. This is my last slide. So on the prior pages, I showed you 6 transactions. It used 600,000 of SSBCI monies. Okay. Well, what does it look like when you insert that into the treasury table? Okay. So this is where your 600 grand goes. That's your allocation. Time to recycling. This right here is, it's a guess. Okay. When you're in the Excel spreadsheet, if you change that number from 2 to 7 to 8, you'll see how it changes your leverage ratio. If you said you were going to make all 10-year loans and you would put 10 in that row, your leverage ratio would go down because you're not getting very much principal payments back that you can recycle. Okay. Remember those percentages of the 5 and the 7 and the 10-year loans? That's what these are right here. When you change your percentages, it changes your leverage ratio. So if you make all 5-year loans, that might be okay. It might actually be to your advantage because you get the loan principal back faster and you can relend it. Okay. So do you remember that average participation rate? It's right here. We got that from our master spreadsheet. End of the day, we come up with a 4.24 leverage ratio. So the application process, number one, you have to complete the application, right? Number two, there has to be a reasonable expectation that you can reach a 10-to-1 leverage ratio in a 10-year time frame. I have a problem with the framework of this, okay? And I went on a soapbox on this last week, but that's here nor there. Let me show you this though. When we think about impact in our communities, I had 19 loan transactions. It created an investment of 5.4 million. It brought in 4.5 million of private capital, and I deployed 883,000. I think that's positive impact in a small tribal community. So this 10-to-1 leverage ratio, when that framework was established, keep in mind the original beneficiaries of version 1.0 of SSBCI back during the Obama administration were states. And states have massive geographies and massive population bases and plenty of time to deploy these funds. And it's probably a very short list of states that reach 10-to-1. Many of them, I'm hearing anecdotally, 4-to-1, 5-to-1, 6-to-1. The government didn't take their money back. The impact is the impact. If it turns out that your leverage ratio is lower than the bar, don't sweat it. Don't worry about it. Write your story. Tell your story. Say in my small community, I think I can do 19 projects. That's going to bring in $4.5 million of outside investment that I do not have now, that I was able to attract with your money, Mr. Treasury. So everybody on this call has probably written grants before. They're all about telling your story. And what I did here is I just kind of shared my path on learning this and trying to figure it out. I'm not guaranteeing it's perfect, okay? But these spreadsheets that I shared with you, I've been on Zoom calls with Treasury guys, and they're like, makes sense to me. You're on track. We understand your thinking. Now write it down, okay? So, by the way, there's one more tab to that Treasury table, and this is what it looks like. Your loan data, all you're doing is taking that hypothetical activity and inserting it here. I got a $100,000 project, an $800,000 project. I spread them out over 4 years. This is the only area you actually enter your data, and then it'll auto-populate all of this up there. This is just a time frame. So here's what's cool about this visual. Let's say you really could make all these loans in 4 years. By year 2 and 3 and 4, they're starting to pay back. And you're going to have, if you wanted to, and you were really ambitious, you could come up with some assumptions for those repayment dollars and insert them in year 5, year 6, year 7, year 8. That's going to increase your leverage. So I'm going to stop sharing, and I'll email this out to people. I hope it helps you. You know, it's just all these ideas that I put down on paper, and the math is the math. And my way of doing the math is I am a real live commercial loan guy every day, and I know how projects get funded. So I think my assumptions make sense, but what makes sense for your community? So my contact information will be on the first page of this. And, you know, you want to give me a shout or send me an email, be more than happy to share that with you. And by the way, when I've been on a conference call with Treasury, they're like, Jeff, this is some awesome stuff. I wish you could share it. That's why I'm doing this today. And also our shareholder, the Oneida Nation, we spent a lot of time developing our program. And they're like, we don't call it tribal council in Oneida, we call it business committee. And so the word from the business committee is like, we understand Jeff has accumulated a lot of information. If he could share that to help the others, we'd really appreciate that. So when mom and dad asked me to do something, you know, I put it together. So,
Thank
but
you,
again,
Jeff.
you know, feel free to reach out to me if you need some help. I'll do
Okay.
the best I can.
No, I appreciate it, and very eye-opening, and it really simplifies things. So I
I gotta
appreciate
have
it.
one last thing.
Yes.
The person that put me on this path, one of them is Pilar. I started listening to Pilar when you had her doing the original presentations. And so Pilar, I haven't forgot about you. I'm just not ready to use you yet, but so she's got a lot of the policy and regulatory knowledge. I just got the worker bee loan guy side knowledge that I tried to share with you today. So Pilar, thank you for helping me get to this point.
Thanks for the math, Jeff. That's why lawyers and bankers go so well together.
Most of the time, unless we're on the other side of the table from each other.
Well, thank you, Jeff. And we'll move on to Pilar Thomas. Everybody who's been following with us knows Pilar, an attorney and an SSBCI expert. Will share two template agreements that tribal governments and Native CDFIs can use for partnering to access the technical assistance and capital deployment funding of the SSBCI program. So Pilar, I'm not going to waste too much time because we want to hear from you, and everyone's excited to hear. So take her away.
Yeah, I apologize for being late. This is the math for me. This is why I don't do math. I couldn't figure out the difference in time. Pete, do I have share screen capability?
Harrison, can you share screen?
Yep, I'm on it.
Okay.
Thank you. And in this presentation will be available to everyone as these are, Pete gets them around. So I think Pete asked me, so one of the things we did a couple of months ago was we put out a white paper. NCN put out a white paper sponsored by several other CDFI and CDFI adjacent organizations. Hopefully that white paper was helpful. The idea there was to provide some background of the SSBCI program and some potential models that Native CDFIs and their tribal sponsors or partners could look to as a way to, most importantly, develop some turnkey options and solutions for deploying your SSBCI funds. And you've just heard from Jeff of the challenge of getting 10 to 1. Let me put an asterisk on that. The only number that you actually have to meet is 1 to 1. That's the only number you have to meet. You have to show an effort to meet 10 to 1. The leverage tables are there to help you get to 10 to 1, but there is no penalty if you don't hit 10 to 1. If you hit, and the states didn't hit 10 to 1 the last time around, they came in at about 8 or so to 1 overall. So play with the numbers, or as we like to say, cook the books and find a way to get to 10 to 1. But the only number you have to hit is 1 to 1. So just keep that in mind as you're looking at your programs. Okay, do I have share screen yet? Okay, here we go. So I'm going to talk about a couple of things as follow-up to the white paper. Can you see my share screen, Pete?
Yep.
Okay, let's so it says program agreements.
Yep, we've got that. And your sidebar is showing there.
Oh, shoot, it's always doing that. All right, well, that's okay.
Okay.
Because I know time is of the essence and I apologize for being late. So let me just again, a background on me. So a thing I want to run through as a reminder of the models that we looked at with the CDFI as the administrator of a SSBCI program, and the 3 models that we discussed in previous webinars and as are reflected in the white paper. I'm also going to then talk about some key program description language. So I call it model because it's a basic framework for filing with Treasury your application and the program description that goes with that. And we're going to focus on the loan participation program because I think that seems to be the program that most people are interested in the most, and for good reason. I'm going to talk about, I've developed an administrative services agreement. I've stolen a lot of language. Oh, I guess that's not technically the term. I've borrowed a lot of language from the state of Georgia and the state of Florida, both of whom have used third-party administrators for their program. So I've tried to not reinvent the wheel, but to develop something that looks like it will work for tribes. Georgia's is actually the best because Georgia had a program similar to the Washington State's Craft 3 model, where they deployed a direct lending program directly with CDFIs. So the administrative services agreement is this, the one I'm drafting, the elements I'll talk through are from Georgia in that direct lending model. And there's also similar language they've used for the loan guarantee program and a loan participation program. So it can be, it's kind of modular. I've developed kind of a modular document that will cover off a whole host of things. And then the lender participation agreement, which is what the CDFI, if you're administering the program, you would enter into with other lenders to participate in the program. So as a reminder, CDFIs as administrators, we have the direct loan program. We refer to that as the Washington model or the Craft 3 model. Georgia had a similar model, but they combined it with a loan participation program. In this program, the direct loan, you just give your money to the CDFI, or the tribe gives the money to the CDFI. CDFI matches it with its own money. There's your one-to-one. So a tribe has $1 million. They give $1 million to the CDFI. The CDFI matches it with the other $1 million. I've got my one-to-one instantly. That's all I have to do by statute. And then as to Jeff's point, as you relend and relend, you lend, you get repaid, you relend again. Now your leverage is building. And so you off to the races you go. So that's the direct model. The loan participation program, which is also what Georgia did, developing a lender network. You're using SSBCI funds as either co-loans or as participation, purchasing the interest of a loan. You're able to track performance of both loans. Of course, both of them in both of these examples, the CDFI is making revenue off of the loan that's been made, right? Your interest income, your fee income. So both of these models are a typical lending model for CDFIs where income is coming in from the investment, the interest income, and then you're relending it. And of course, you're continuing to make more funds. You retain principal interest that's repaid to relend, and also you can use it to pay costs.
Yes. If you could move your slides along as you go there, we're stuck on that, your main slide there.
Okay, I'm gonna do this differently then.
Okay.
Let me try this again. Sorry about that. All right, let me try this again. Let's see. Okay, is that moving now?
No, it is not. I think if you go to from the beginning, maybe.
All right. That's what happens when I have too many slides up. Okay, what do you see now?
If you go up to the left there and hit click from the beginning.
You're still not seeing it?
No, actually maybe click on that third slide or the fourth slide there once, just click on it to your left. There you go. And that should change the slide. For some reason it's not changing on your slide deck.
Yeah, that's kind of weird. I
Do you have
apologize.
multiple monitors?
Yeah, is that what it is?
That's what it is.
Okay,
It does the full presentation on one screen and the other view on the other, but Zoom isn't smart enough to know.
Okay, I'm going to I'm gonna do this. Okay, now what do you see?
Now we see the CDFI administrator slide, that top one there.
Okay, and do you see just the slide?
No, we still see your sidebar, but I think if you click on your slide bar on your main screen there to your right of the larger slide, you can scroll up and down with it. Keep going to your right. There you go.
Okay. Now what do you see?
Now we see the first slide again.
Is it changing?
No. You see the first slide there, and then there's a sliding bar to the right of it.
What screen is it? Is it?
Yeah.
All right, well, this is
Okay.
now user error.
Maybe you could email it to Pete and then Pete could scroll through it as you're speaking.
Yeah.
to it.
I did email it to Pete. Pete, can you pull it up and maybe you can do it?
Let's see here. Mhm. All right.
See, it says now you can see my application.
Can you see that now?
Okay. Can you see it? There you go.
Yeah, there we go. Okay, and we were at slide,
We were at slide 5.
5, okay.
Okay. So, okay, can we see that again? Okay.
Yep.
All right, so let's go to slide 5. So we had the direct loan, we had the loan participation, and then the loan guarantee. So 3 types of loan programs. Of course, there are more than that in SSBCI. Excuse me, these are the ones we've been talking about the most. So as an administrator of a loan guarantee program, same basic, you got to develop a lender network. You're going to hold that loan guarantee fund. You're going to approve the loan guarantee itself. Your revenue, so to speak, in a loan guarantee administration is receiving loan guarantee fees. The state of Georgia, for example, had a one-time 2% fee on the full loan amount. That's consistent with Treasury's guidance on fees that can be charged outside of regular application fees. They also had a annual guarantee fee that they were charging. So you're not going to be just stuck with 2%. You can in fact increase that and keep going. Now, of course, for the SSBCIs, I'm sorry, for the CDFIs, as just a reminder, one of the key benefits of being the administrator especially for smaller CDFIs, as you're building your own capacity, you're generating revenue either on loan interest or on fees. And if you negotiate with the tribe, then at the end of the 10-year period, and many states, as I have said before, many states did this, they left the SSBCI funds with their CDFIs to continue to use them as unrestricted capital. But that's going to be between the CDFI and the tribe to negotiate that. Next slide. So, one of our key reminders, responsibilities, we've got to have skill, capacity. We have to put this in the application. There's a document, a narrative we have to download. The tribes have to download with their application around operational capability, skill. How do you manage increase in small business lending? This is something the CDFI would have to provide to the tribe as they submit their application. Additional questions around the program. How are you going to market it? You have to develop a lender network, and that would involve, for example, loan guarantee and participation agreements. You might have tribal conflict of interest rules and ethics policies. So the next slide. So I put kind of this administration model together as an example of showing just the CDFI as administrator, not as lender. Unless, of course, you did the direct lending. In the upper right-hand corner, just an idea of some of the documents that we're talking about here. So we have the SSBCI application itself. The tribe is submitting that to Treasury. Treasury is then, assuming it approves the application, is sending to the tribe an allocation agreement. That's between the tribe and Treasury. Treasury has put out a draft allocation agreement. They published that last week. I encourage you to take a look at it. It's up on their website. If you can't find it, let me know. I'll email it to you. There are some changes from the last time. Obviously, to update it as to the current program. What we still do not have from Treasury is reporting requirements and other certifications. So it's a relatively short document. It's only 7 pages or so. No, 12 pages, 13 pages. So again, I encourage you to look at it, but the tribe's going to have to sign that with Treasury to get their money. Once they get their money, the tribe would enter into a services agreement with the CDFI for administration services. The CDFI in turn enters into lender participation agreements between the CDFI and the lenders on how to run the guarantee program or the participation program. And then, of course, the lenders are entering into loan agreements with the borrowers. And that's between the lender and the borrower. So just a list of all the agreements we're talking about. We go next to the loan participation program description. So this is where I'm taking this straight out of the application. The application says, describe, this is again, just for loan participation right now. If you do loan guarantee, you're going to have to do this for the loan guarantee program. So you have to do one of these descriptions for each program you're going to do. So this is loan participation. So we say the loan participation program, describe how it's structured. Is it a purchase participation? Is it a co-loan? Are there companion loans? What's the maximum percentage of the loan that you can participate in? So relatively simple. Here's the key question that Treasury has not yet been able to answer. I know they've had a couple of workshops so far on application and how to do the application. I've asked them very directly, how many words do you want, Treasury? Because in this description, I can answer this in 2 sentences, 3 sentences. Is this enough? I don't know. Treasury hasn't really told us. I need more words than this, or this is enough. So this is going to be a baseline set of information. The loan participation will not participate in more than 50 to 80%. Why 80%? Because the banks have to have, lenders have to have at least 20% at risk. So you can make some decisions to have higher loan participations by loan. The 1-to-1 requirement is at a program level. So if you take your $1 million and you put it all into the loan participation program, that requires another $1 million in bank loans, let's say, 1-to-1. But at each loan, it can be different. You can have a different percentage per loan. So some loans, and Jeff was showing in his leverage table, some loans you might only want to participate at 20 or 30%. Other loans you might want to participate up to 80%. Your goal would be to average participation of 50%. That's how you get the 1-to-1. So we would indicate the maximum percentage is 80% because that's 20% remaining for the bank. That's the minimum they have to meet for at risk. So I would encourage you to have a range because you don't know, you don't want to always be only 50%. You don't want to always be only 80%. I would encourage a range. So that's why I have a range in here. You'll enter into lender participation agreements to purchase a portion of the loan originated, will or will not offer companion loans. That's going to be between, that's going to partly be what the CDFI can do. You can certainly make a companion loan. So bank makes $50,000 loan, you make another $50,000 loan. There's your 1-to-1. It's a co-loan. That's a loan participation program. Two different loans though to the borrower. Or bank makes $100,000 loan, you buy 50% of that, you write the bank a check for 50 grand. That's our just purchase interest. So you have to decide and tell them, what are you going to do? Is it going to be a purchase participation or a companion loan? So you've got to at least figure that out. Next slide, please. So these are words from the application, the A, B. We're going to go through these real quickly. Qualifications or eligibility requirements. So tribal member-owned small businesses are eligible if they're located in the state of X. Remember, if your tribe is located in Iowa, you can lend to any small business in Iowa, and you can lend to any tribal member-owned small business anywhere. Some tribes want to limit it and say we're only going to lend in our state. So any tribal member-owned small business in the state of X. You might say, if no matter where they're located, tribe will consider any small business located on or near the tribe's reservation, or any small business in the state of X that can demonstrate it employs or will employ members of the tribe. Remember, this is a jobs program. Tribal owned enterprises, are they going to be eligible? 750 employees is our limit. So this is a 2 sentences, 3 sentences that captures tribal member owned businesses, tribal owned enterprises, and any small business on or near the reservation or will employ tribal members. If you have a large urban tribal member population in, Minnesota, for example, and you've got, if you're a rural Minnesota tribe, but you've got a lot of tribal members in Minneapolis, you might want to make loans to small businesses in Minneapolis if they're going to employ tribal members in those businesses. So those are some of your options there. And I tried to just give some examples. Minimum and maximum loan investment amounts. It will apply to the following loan ranges. Pick a minimum. The maximum is always 20 million. Just say it. That's the maximum you can lend. You may not do 20 million, but if you say 1 million and then you need to make a $5 million loan, you can't do it. So have your range wide. So you can make as small a loan as you want to and as large a loan as you can. And then you have an average loan amount. And Jeff walked through your leverage tables that would tell you what that average loan amount might be. If you're trying to figure out a mix of loan amounts, how to get to your 10-to-1 with the money that you've got. So this is just an example. Next slide. Standard terms and conditions. We just punt to the bank. Slide back up, C. So we want to say what our standard loan terms are. We're going to participate in fixed loans, business lines of credit, other standard small loan products offered by the lender, whatever the lender does. Non-standard transactions, defer to the lender, or we don't do any non-standard transactions. All SSBCI dollars will be used to participate in loans, again, for the same eligible businesses. The only limitations, those in the statute. Now, some tribes want to limit where that money is going to go. For example, some tribes have explicitly said, or will explicitly say, we're not going to lend money to XYZ type of company. That's for the tribe to decide. There are statutory limitations. So if you want to keep it wide open, just say the only limitations are those in the statute. Other standard terms required, again, whatever the local lender does. So you might have, as a CDFI, a small business loan set of products. You don't have to create new products. If you have lenders you're going to work with and they have a set of products, you don't have to create new products. Whatever they're offering, that's what we're going to do. Our minimum participation, again, 30%, maximum 80, average 50. So we're saying this again because they're making us do this again. Next slide. So source for loan originations, how are you going to go get the loans? So you might advertise the program to tribal members. You might work with local small business groups. You might work with American Indian Chambers of Commerce. You might align with some incubator and accelerator programs. You might have some on or near reservation nonprofits. The tribe itself might have a small business development program. Remember too that, you know, the BIA has got that incubator program they just came out with grants for, and of course, Treasury has their technical assistance program. So if you intend to leverage some incubator, accelerator, or other technical assistance programs, you'll want to say that here. Process for negotiating or approving loan or credit support. So the local lender makes the underwriting decision. You defer to their underwriting and their loan origination process and whatever procedures they have. You might have a review process in there. So if you do, you'll want to say it. So we'll review the loan before we agree to participate. That's pretty much what every state did. They would get the loan application. They would do a cursory review. They weren't really re-underwriting. And they would just make sure that the loan, the borrower met their qualifications. Is it in the state? Is it this kind of business? Is it for this amount of money? Is it the right business size? Something like that. And then boom, we commit to the participation and off it goes. So that just a key outline of what those processes might be. Cause and result, you're going to track the loans that are issued. You're going to see what the SSBCI fund was, amount. So you're going to get a report from the bank or the lender on all the loans that they've made, how much of your SSBCI money you sent, how much they've made, that you're going to see that one-to-one there. If you're trying to do future leverage, Jeff has shown you the leverage table. We got to keep track of this borrower, that you will want regular reporting on the loans so that you can see, is there a new loan? I think by estimates, you'll probably have to anticipate making more than one loan to the same business. So business A is startup. I'm going to make them a $10,000 loan. They're going to get going. They're going to then come back and they're going to apply for a $25,000 loan. That's going to improve your leverage. So you're going to want to keep track of these borrowers and see how they're doing so you can keep track of this leverage. Okay, so those are the things. Next slide. The last three things we have to answer. Sorry, kinds and rates for fees. Sorry, back up one more. There you go. Thank you. So you have to tell the Treasury the kind of and rates for fees. So I've got my typical interest rate. I got some application origination fees. I might have a guarantee fee. If it's a venture capital, I might have management fees. So just say we're going to charge a 2% participation fee on the full amount of the loan. You might say the same thing for a loan guarantee. The lenders will be able to charge their standard fees. Rates will be limited based on Treasury guidance because Treasury has told us we're going to have limits. You might negotiate with the bank that you get your pro rata share of fees and interest rate charges. If you own the loan, if you buy into the loan as a purchase participation, you're going to get your pro rata share of the interest income from that loan. So it's a $100,000 loan. Let's say you went 50-50. So you wrote a check for 50 grand. You're going to get 50% of the interest income that's coming in off that loan. So you want to indicate that you're going to get your pro rata share and what those rates are going to be. Process for monitoring, the local lenders will report on loan performance. You'll monitor that. Reporting will include demographic, all other information required. The allocation agreement will tell us what those requirements are. And then finally, loan defaults, defer to the lender. So if they become delinquent and fail to pay, you're going to require the lender to pursue and comply with standard collection charge-off policies and procedures, diligent collection efforts for allocating and accounting for loan losses. And you want to make sure that all that's in the participation agreement. Okay, so let's talk about an administrative services agreement. Here's what kind of the key elements are. We've got the definitions. Of course, your program is going to partly define that, but you'll have definitions. Who's the tribe? Who's the contracting entity? Affiliates. You'll have conflict of interest provisions. You'll have reps and warranties, right? So the tribe and the CDFI will want, of course, be able to say they're both authorized to enter into the contract. The CDFI will have representations and warranties around the work that they'll do. That'll include a scope of work, a definition of the loan programs that will be administered. So you'll take that program description that you sent to Treasury and you will attach it to the agreement. Here's our program description. Here's the program you're going to run because this is what Treasury approved. You'll have to keep track of administration. How do you enroll programs? How do you administer these loans? What the exact scope of work is and process, the internal process could also be an attachment. So the mechanics of approving participation, what do you get to do with the program income? And then possibly keeping the funding. So if program income comes in, program income is defined in three ways, really. You've got if you get a bucket of money to spend, you're going to put in a bank account, you're going to make interest income, you're going to make a loan. So you're going to get interest income from that, and then you're going to have fees on that. You're going to be able to use that program income for your own operating expenses. I know that's been a big issue or question. Remember, the tribes can use up to 5% of the first tranche, 3% of the next two tranches for quote unquote administrative expenses, depending on how much money the tribe gets and how much implementation they have to do. They might be willing to share that administrative allocation with you, 50-50, 20-30, or 70-30, whatever it might be. So that helps defray costs, but your operating expenses, especially in a loan participation program, are going to be covered by fees and interest income. So even though technically that's program income, you can use it for your operating expenses. And then whatever's left over, your net income, if you will go back into relending. And then the question of who keeps the money at the end of the 10 years, at the end of the agreement. You obviously have to be able to terminate. The tribe has to be able to get out of this at any time. So if you're not doing your job or they change their mind about the kind of program they want to run, there are termination provisions in here. Loans that are already enrolled, loans that you're already participating in are still there. So there will be a tail to that. But it's go forward that would happen. And then defaults and remedies. What happens if the tribe defaults? What happens if you default? And what your remedies are. So pretty basic services agreement. Again, I would look to Georgia's direct lending program for a good, robust contract here. That's the one I'm using and developing for tribes off of that one. Let me end with the lender participation agreement. Again, I'm using a combination of Georgia and North Carolina, just simply because they both have a pretty robust master participation agreement with a lot of description of process. And so that's a good way to start. Again, no sense in reinventing the wheel. This is going to be between, if the tribe is implementing and administering, them and the lender, if the CDFI is administering, between the CDFI and the lender. Similar reps and warranties. One of the key aspects of this is the lender has to warrant to you, the administrator, that they will comply with all of the SSBCI statute, guidance, and your allocation agreement. One of the things that's in these participation agreements is an attachment and annexation of the allocation agreement, because the tribe is bound by this allocation agreement. So it's going to flow down to your lenders. They're going to also have to rep and warrant that the borrower is an eligible borrower, all the limitations on the borrower that there might be, that they understand their limitations. They'll comply with your conflict of interest rules. Nobody is a sex predator. There isn't any, the funds aren't being used for illegal activity and all the other limitations. So your lender has to rep and warrant that the loans they're going to make are going to comply with the SSBCI statute and guidance and your allocation agreement. That's the guts of the reps and warranties. Then there's a description of the loan participation program, what that process is, who's going to own these loans, is there an undivided interest, is there ownership, who owns collateral, what the actual ownership interest is, because you're buying into a loan. So what do you own and what does the bank own? How are you going to share revenues and fees? Pro rata, how are you going to allocate that? How often are you going to get paid? So as the loan gets repaid and the interest income is earned by the bank, they should be sending you a check every month, or maybe it's quarterly. You decide that. What's the loan servicing and payments process? Again, making sure you get paid. And then how are collections and write-offs happening? Because remember, they have to keep 20% at risk. So even if you went in 50-50, you got to make sure that if there's a write-off, they take their 20% hit right off the top. And then you're going to take some portion of a hit as well, because you're participating in it. So, so again, I'm happy to answer more questions in detail on this, but and happy to send in. I think Treasury sent around a link to the Georgia documents. I don't know if Pete, they sent them to you guys, but if not, I've got the Georgia documents in their original form, and then I'm starting to work up with everybody the tribal version of that. So I want to just walk through what's kind of in each document here. So with that, happy to take any questions.
You know, Pilar, I have one question off the bat, and I asked Treasury this. You know, let's say the tribe says we don't want to partner with you anymore and we're going to move on. And a CDFI as a lender has money into the program. The tribe would have to come back and to get the CDFI out, pay off those loans, because the only one hurt in that scenario would be the borrower. Would that be right?
Yeah, so usually there's the termination provisions as drafted now are go forward terminations. So it's, you can't make any future loans. So if, let's say Tribe A sent to the CDFI, sent them $1 million and said, you're going to run our loan participation program with third-party lenders. You're not going to make any loans, CDFI, but you're going to do participation. So they go to Bank of America, Key Bank, Jeff at Bay Bank, and say, hey, we're going to do loan participation with you. So the CDFI is $1 million sitting in a SSBCI fund. Let's call it that, the bank account. And as loans come in, then you write checks to the lenders for loan participation. So you have an agreement with the tribe to do that. The termination says, if the tribe comes to you and says, dear CDFI, we're going to take $500,000 away from you because we're going to do a venture capital fund now. And so we sent you $1 million, but now we've decided to do a second program and somebody else is going to administer it. So you send us back, you know, whatever money you have, or this amount of money. They can't, you don't really want to have to buy out the participation loan. You want to leave it there. So that's kind of the tail. It's future loans that you would not do anymore.
Okay.
So you might withdraw the funds that are there that haven't been committed yet. So the idea would be CDFI doesn't do anymore, as an example, worst case scenario. Don't do any more loan participation. Send us back what you've got. You keep the loans that you've got in place. So you're going to continue to get the interest income from those. And it might even be, you can even keep relending the money as it gets repaid. We just don't want you to do any new loans. So you have to work that out with the tribe and work that into the agreement. Okay. But a tribe has to be able to terminate these agreements at any time, again, for a couple of different reasons. One, they might change their mind about the programs they want to do. So those of you who know I've been telling tribes, just do one program, you can change them later. So, you might have that scenario, or you might be messing up and the tribe says, yeah, we don't want you to do this anymore for us because you're messing up. So we got to terminate the agreement. So, and anything in between, right? So the tribe needs to be able to, and the allocation agreements require the tribes to be able to get out of their contracting entities at any time.
Okay. All right, I appreciate it. And I want to, anyone has any questions or follow-up questions, please put them in the chat and we'll make sure that we get to them. But I want to move on to our third speaker, which is Sanford Livingston II, CEO of Nor-Cal Financial Development Corporation. In addition to overseeing the administration programs and development plan for Nor-Cal FDC, Sanford has overall strategic and operational responsibility for staff's program expansion and execution of the mission. Pilar and I have been on 3 or 4 calls with Nor-Cal here and Sanford's team. And really, Sanford is located in California and has offered and is looking to assist any tribal nations in California. I believe Sanford is your area, assisting in the SSBCI program.
Yes.
So I'm going to turn it over to you since we're running a little bit behind, but please take the mic, Sanford, and
Well, I have
us.
it. Thanks, Pete. Thank you. And just to let you know, I won't be too long. I don't have a presentation or anything, but what I've learned from Jeff and Pilar and yourself is that there is some funding and some resources that are available, that have become available from the federal sense, that have been allocated down from a state sense, and just kind of give you an idea of what's happening in California real briefly. Again, my name is Sanford Livingston. I'm the CEO of Nor-Cal Financial Development Corp. FDC. I have with me Lydia Esdale, who's the Executive Director of Program, as well as Stephen Craddock, who's his Native American tribal relations is giving us some insight into how we might be able to lend information to all the folks on the line and see how we can make it easier to get these resources allocated to the various tribes that it's available to. One of the things we're looking at is that we had an allocation of about 168 million from the first SSBCI. It got split between Treasury and the iBank, the Infrastructure Bank of California, of which we got that 84, 86, whatever million dollars to work with the guarantee program that we have, the State Small Business Guarantee Program in California. Nor-Cal has about 45 relationships with lenders, many of them CDFIs, some other regional banks. And what we do is we make it a little bit easier for lenders to make the decision to get debt capital, make it available to small business entrepreneurs where the collateral is thin, where the LTV values aren't where they need to be. And we can help with that by affording the guarantee program to those lenders so they can be able to make those deals come to life. We would like to do that for Native American-based deals as well with various tribes in California. The funding that we work with, so the SSBCI funds come into California and they're in a trust with the iBank, and we leverage it 10-to-1, as Pilar was saying. And we're really working to figure out how to make sure that many other audiences have usage of these funds. So one of the things we work with is CDFIs, because they then go and they can target certain audiences, say for instance, the tribes, and say, if we have these funds, we can actually work, with them for technical assistance, projections, and those types of things. And when we get the deal, we look at it, takes us about 10 days, and we go through. So I'm giving you the kind of information and thought process that Pilar and Jeff were talking about when we talked about just the guarantee component. So this lets you know how that particular operation runs. So there's 7 FDCs in California, of which Nor-Cal is one of them. So the 7 FDCs work with the iBank. We have contractual agreements, and we cover the whole state. So all of those funds are being used for various businesses, you know, to get them the capital that they need within the state. We do have resources outside of California. So there are CDFIs that are outside the state, but you need to use funds for particular tribes within the state. We can work to get those CDFIs, what we call certified. The state actually has, we have a mechanism and a kind of a timeline and track record to help CDFIs, lenders get certified with the state, of which they would then be able to use the guarantee program to do that. And we're just really speaking with Pete, speaking with Pilar, speaking with everyone to figure out how we can use our kind of our structure and our strategy and our process to be able to get these funds successfully to the folks that need it the most. One of the things I would love to say is that California still has all of the funds from the SSBCI from the first tranche because of the way that we operate and the way that we leverage those funds. I would say that, you know, those 84 million were allocated in the best that we could. Now we're talking about $400 million coming down to be used for the same purposes. And many states, for whatever reason, you know, chose to use strategies that the funds ended up evaporating for whatever reason. It was hard to get them back. But with the processes that we have where everybody kind of stays in their lane to do those things, our default ratio is around 2% for the whole program since '68 in California. And for Nor-Cal in particular, it's less than 1%. So we love working with folks to allocate these funds. We would like to talk to anyone about the processes that we've developed. If there's any partnerships that we have access to, again, like I said, we have 45 lenders that we work with. If there's any way we can provide information, the information from Pilar and Jeff was absolutely stellar. And I think that we're probably going to have some type of a webinar, particularly for California, but it's a great economy here, and there's some great ideas and I would say success stories and tactics that we can use to benefit everyone around the country. So that was what I wanted to make sure we got across to you. If we need any, you know, if you want to ask us any questions or anything, Pete, you definitely know how to get in touch with us. Stephen, if anyone else has anything else they want to kind of say, I know we're running behind time, but I wanted to let you know that I love what I'm hearing. I just want to find a way that we could, you know, kind of connect and partnership with those around the country to figure out how we can make you successful in getting the companies that you need to get funding to get the debt capital that they need to run their businesses.
Thank you. Thank you, Livingston. And we appreciate working with you and sharing ideas in the calls we have with Pilar. One of the things that I want to stress is that we will be putting up the information that Jeff shared and that Pilar shared on our website. So we will send out the links to those, probably be tomorrow. But any questions that are, anyone have a burning desire to ask a question here? Okay, I don't see any hands up. No, I loved all the presentations today, and I think Jeff's simplistic approach, it really put it in perspective. And then with the way that Pilar prepared her comments also is the simplicity of keeping it simple and finding out from Treasury if there are minimum and maximum word requirements. I think that would be beneficial. So other than that, wait, no, here we go. Oh, yeah, a lot of comments that the presentations were very beneficial today. And Pilar, are there, Artis has a question, are there any sample template administrative service agreements that can be shared with the group? We might have lost Pilar. I know she was busy and had a
Oh,
hard.
sorry.
Okay,
You know what? I was on go-to meeting and the thing's in a different spot. Okay, so I'm happy to send the Georgia document and the Florida document, so you can see kind of what the approach that two states took. I'm using the Georgia document now as my primary model. Again, reworking it from a tribal perspective. A lot of blanks in it because you got to negotiate that between the tribe and whoever's administering. But I found the Georgia document for kind of this real arm's length transaction to be very detailed, and it's especially built around if the CDFI is going to play a dual role. One of the models that we talked about was a dual role for the CDFI, both as a lender and as an administrator. And that Georgia document is actually really good for both of those because that's how they set up their CDFI program. Their CDFIs were both doing direct lending and doing loan participation. So it's all kind of in one. So I'm happy to send that for you to take a look at as that's what I'm working off of. It does, but obviously for my other clients, I'm reworking it based on their circumstances, but that's the model I'm working off of, is that Georgia document. I think I did find, and I'm working with some of the folks on here for some other programs with their tribes. Depending on, how detailed you want it to be, there's also an example that I've looked at with New Hampshire, where they had an agreement between the two agencies of the state. So it was an intrastate agreement. And so that might be more appropriate if the CDFI is, for example, wholly owned by the tribe. And so that's more of an intra-tribal agreement where, say, a tribe in its Section 17 or a tribe in its wholly owned native CDFI, you may not need something as formal as, say, a state and a third independent CDFI. So those are some, and I'm happy to send over that New Hampshire document so you can see what an intra-state agreement looks like. Those are the documents I've been working off of, just because there's 3 different models for 3 different situations. So that's what I've been using.
and then I want to send out a special thank you to Clearinghouse CDFI and Andy Gordon for being a co-sponsor for today's event with us. We couldn't have done it without assistance from Andy and his team. Then also the previous webinars were sponsored by OESTA and the Sovereign Council of Hawaiian Homestead Association and Clearinghouse and the Native CDFI. So thank you, Andy and OESTA and the Sovereign Council. Thank you very much. And I want to thank our guests today, Jeff Bowman, Pilar Thomas, and Mr. Livingston. I really appreciated all of your comments, and please reach out to me with my email at pete@nativecdfi.net if you have any questions, and I can get those forwarded to our guest speakers. Yeah, Cindy Logston would love to see the New Hampshire one, so we'll make sure we get that to you. So any other closing comments or questions? If not, we will, let me find the chat here quick. Nope. Okay, I appreciate and I thank you all very much for attending, and we will get that posted on our website. Like I said, it'll be tomorrow. If you need it sooner, reach out to me and I'll see if I can turn it around quicker for you. Thank you.
All right, bye, everybody.
Thanks, Pete.
You bet. Thank you,
Thank you,
Pilar,
Pete.
Jeff.
Thank you so
Happy
much.
hump day, everybody.
Thank you.
Thank you.
Sanford, thank you.